Alright, this is what you need to know, part 2. How to trade options using the Golden Gecko style, takes your trade way by lowering your cost basis. Let me do a real quick review of part 1. Part 1, all we discussed was the basics. Everyone on how to bet that your stock you pick will go higher. So, like everyone does, they buy stocks hoping that it'll go higher. Well, the takes your trade way is, instead of doing that, you want to lower your cost basis in your position. What that means is if a stock is, let's say a stock is worth $100 right now, what if you could get that same stock for $90 instead of $100 right now? Could you do it? Yes. And we discussed in part 1, you can do that by what's known as selling a put. And again, I showed that how you could do that using the new Tasty Trade platform called Dough. It makes it really easy to trade options, and when you're ready to do real money, just open an account through Dough right here. Open an account at Thinkorswim with TD Ameritrade, and you can do that through Dough. Why? You get a better commission structure, and you're helping Tasty Trade keep the lights on, and you're supporting them. Okay, so when you log into your Dough, you wanna, let me show you what selling a put. Let's review what selling a put means. Hit that trade icon. This screen will pop up right here. You want to type in here SPY. That stands for the S&P 500, the most commonly measure of how the U.S. stock market is doing. Excuse me, and this page will come up. You want to go to choose strategy, and you want to go to option. You want to make sure short put option is clicked. Short put just means selling a put. You want to make sure that star is there so it's default. You want to expand that. Make sure this says 45 days to expiration. You want to make sure your monthly is selected. You want to click on your 1 standard deviation icon, so this is 84% out of the money, and then you want to hit go. Okay, again, now here's what selling a put means. I'm doing a little recap. Selling a put simply means is you're making a bet, okay, against someone else that you're thinking that the S&P 500 in this case will be above $186 within the next by the end of 61 days, which is the third expiration is always the third Friday of every month, so in this case September 20th, 2014. Okay, now don't forget, when I say selling a put, we're selling a put where? 1 standard deviation below where the current price is right now, and that means out of the money. Okay, so you're selling one put at the 1 standard deviation line, which is this blue or vertical line right here. Okay, that gives you an 89% or 87% probability of breaking even. Okay, so everything in the green area, again, you're making money. Everything in the red area, you're losing money. This is how you're lowering your cost basis. Why? Because you can make money even if it drops all the way down to 186. You still make money. If it stays the same, you still make money. If it goes higher, but at the end of 61 days, you still make money. So you can make money 3 ways when you sell a put, instead of only 1 way when you buy a stock. Real quick review. How much money are you collecting? Well, you're making a bet, so someone's actually going to pay you $1.19 per contract, or $119 for 100 shares. Alright, so you're going to collect $119 from a guy who's betting opposite you. You're betting that person that the market will be above 186, and in exchange they're betting you that it'll be below, so they're paying you $119. If at the end of 61 days the market is above $186, you keep that whole $119. The guy gets nothing. You can choose, as we do in the Tasty Trade way, to manage your profits at 50% of your max profit. What does that mean? Hey, if any point in time that put you sold is worth 59 cents, or if it drops down to 59 cents, okay, what that means is you sold it, you collected $119. You could buy it back for 59 cents, so you keep 50% of the profit, and the guy you bet against, I guess he saved, instead of losing 100% of his money, he only loses 50% of his $1.19 or $119. Okay, so that was part 1. Why? Because you can sell a put in anything. Now you could say, oh Mark, I want to bet that Google will go up. Okay, great. Sell a put in Google, right? How do you do that? Same way. Click on trade. Type in the stock symbol for Google. Okay, I'll clear this. You can type a stock symbol for Google. GOOG, hit enter. Alright, you're going to go, and where do we sell a put? 1 standard deviation below the current price, or that's called 1 standard deviation out of the money. Click on choose strategy, click on option, short put option, make sure this is 45 days, click on 1 standard deviation, hit go. Look what happens. Boom. See, Google is trading at $5.95. You're going to sell a put at $5.45, which is 1 standard deviation out of the money. You're going to collect $3.30 to do it, or $330. You're betting you have an 88% chance of being right. Where do you make money? Anywhere in the green, which means Google could drop all the way down from $5.95 all the way down to $545, and you still make money. If it goes higher, doesn't matter how high it goes, you still make money. If Google at the end of 61 days is still the exact same price, you still make money. Okay? So that's part 1. Now part 2 should be really easy, because in part 2 I'm going to teach you what the opposite is of selling a put. Okay, so what do you think the opposite of selling a put is? If selling a put means you're betting that the stock market or that stock you're picking will go up, the opposite would be betting that you think that that stock will go down, and that is called selling a call. Okay, let's do the same thing. Type in SPY. Okay, you're going to go to choose strategy, you're going to go to options, and this time instead of short put, instead of selling put, you want to do the opposite of that, which is selling a call or a short call. Okay, make sure this is 45 days, check that on monthly, check on 1 standard deviation, you're going to hit go. Now in this case, whoops, screwed up there. Choose strategy, short put, I'm going to click on short call. Okay, make sure this is right and click on go. Alright, now again, what are you doing? You're selling a call 1 standard deviation out of the money. In this case, it'll be 1 standard deviation above the current price. Okay, so you can see it popped a little higher. You can easily grab it and move it over so it's as close to that 1 line as you can. Here it is. Okay, so now look, you're betting that the S&P 500 will stay below $210. Okay, in this case. So that means, look what happened. That means if the stock market goes at the end of 61 days, if the stock market is even at 200, if it goes high as 210, you're still not going to lose money. If it stays the same, you're going to make money. And of course, if it drops, you're still going to make money. Okay? What are your odds of that happening? What are your probability of profit? You have an 86% chance of making money. Okay? If you want to see it another way, you can click on this leg button and here, 86%. Okay, now how much are you going to make? So who's willing to make that bet with you? Who's willing to pay you for that bet? And how much will you collect? Because you're going to hold the money. Well, you're only going to collect a nickel. Why? Okay, because most people are, I guess, the market is saying that you have such a great chance of being right that they don't want to pay you any money for it. Okay, but we'll get to that later. But all that means is somebody's paying you 5 cents or $5. Okay, per 5 cents per contract or $5 per contract that you're gonna because they're betting it'll be higher than this. Okay, you're betting it'll be below. That's why all the green is low and all the red is high. I'm sorry. That's why everywhere it's green is your profit. So and everywhere it's red is is where you'd lose money. So in this case, you're betting someone that the stock market will go down, and that person you're making that bet with is betting that it'll be higher than $210 at the end of 61 days. Okay? So basically that's the definition of selling a call or being bearish. Bearish means you think that the price of that stock will go down. So you could pick any stock and do it again. Oh, Mark, I think Google is going to go lower. Well, let's see how that works. You can type in Google, hit enter, and Google will come up. Click on choose strategy, click on option, click on short call option. Make sure this is 45 days, okay? Click on go, and it'll take you to the nearest 45-day option. Now here's Google. So look, and it's a little bit past this blue line. See this 1 standard deviation line? You want to move it in as close as you can, right around there, okay? Okay. I'll explain what this teardrop means a little bit later, but I want you to grab the concept. So what are you betting? Okay, what are you saying by placing this bet, this trade? You're betting that Google, which is now at $595 right here, you're betting that by the end, at 61 days, that Google will stay below $640. Everywhere in green, you make money. If it goes higher than wherever it's red, it'll lose money. So again, you can make money three ways. Okay, what's your probability of being right? You have an 82% chance of being right, what this means is you have an 82% chance of Google expiring out of the money. Okay, which means it won't get past this and come higher than that. Okay, how much will someone pay you for that bet? Well, someone's going to pay you $2.90 that they think it'll go higher than $640 up here at the end of 61 days. You're betting that they're wrong and it'll stay below. Okay, and for that bet, they're going to pay you $2.90. Okay, now what happens at the end of 61 days and the Google is still right here? You keep this whole $2.90 per contract, or $290. Okay, let's say there's only 1 day left, or let's say there's only 10 days left to go, and there's 10 days left to go, and it's still the same place, right? Now you can take the chance and wait another 10 days, or you can buy it back from that guy. What does that mean? Well, what if in 10 days you could buy it back for only 90 cents? You sold it for $2.90, right? And you're going to buy it back for 90 cents. How much profit did you make? Well, $2.90 minus 90 is $2. You made $2 on that trade, or 200 bucks. Okay? And that's the opposite of selling a put. So in part 1, I covered selling a put, and in this episode, in part 2, I covered the opposite of that, which is selling a call. Remember, selling a put means what? You think that that whatever you're betting on, whatever stock it is, let's say the market, you're betting that stock will go higher. Okay? If you're selling a call, you're betting that the stock will go lower. Where do you sell your put? Where's the ideal place to sell your put and call? You want to sell your put or call 1 standard deviation out of the money. So again, repetition is the mother of all learning. Here's the S&P 500. It's at 197. You're selling a put at $186. Why? Because that's 1 standard deviation out of the money, or 1 standard deviation below where this current stock is right now. And you're betting, because you're betting that the stock will remain higher. How can you check what your probability of profit is? You look at POP right here. You have an 89% chance of making money. Click on lagging, and you have an 87% chance of not losing a penny. Okay, they're real close. How much are you collecting? You're betting that someone's willing to bet you $1.19. So they give you $1.19 or $119 because they're betting you that it'll stay below 186. Okay. In part 2, we covered what? Selling a call, which is the opposite of selling a put. Go to options, go to short call, 1 standard deviation, hit go. Now you're betting that what? The stock will stay below this price right here. Okay, what is your probability? Oh, we can move it to that one line. What's your probability? You have 86% chance of being right. Okay, you have an 86% chance of being right. How much is someone willing to pay you for that bet? A nickel, or $5. So in part 1 and part 2, I covered the real basics. If you can understand, in part 1 and part 2, I covered the basics of selling a put and selling a call. These are your foundations. Once you have this down, you can pretty much learn anything. Okay, and these are called naked. They call them, if you hear the word terminology, selling a naked put, selling a naked call, a naked put. What does that mean? It just means there's nothing around it. See, it's naked. There's no call. There's nothing else. It's just by itself, naked. What does a naked put look like? Well, same thing. Okay, here's a naked put. Click, 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 click. Naked put. All by itself. So if you can learn a naked put and you can learn a naked call, that is all you need to know to learn how to trade golden geckos, and that's all you need to know for the simple basics of option trading. Stay tuned for part 3.